Welcome back to the FX Street 8:15 webinar. My name is Adam Rosen. Very happy you could join us today. At 8:30, I want to make sure, by the way, that you can see my charts and hear my voice coming through. I'm assuming all that's okay. All right, so welcome back to FX Street. At 8:30, we have GDP. U.S. GDP will be released, gross domestic product. The consensus is GDP will rise at a rate of 2.8% on a quarter-over-quarter basis, and that would follow the previous month's estimate of 2.0%. Gross domestic product is the measurement of all goods and services, basically all business that's done in the country over the course of a certain period of time, and this is a quarterly figure which is revised on a monthly basis. So again, we're expecting 2.8% versus last month's 2.0%. We have a number of charts to take a look at, including this one. These are charts that I've maintained for quite a while now. If they're not 100% accurate, it's just because I didn't copy the data the right way. But for the most part, I think these charts should be pretty accurate. What we're looking at is a blue line, which is U.S. GDP and its own 12-month moving average. Now, what's interesting is that the last estimate, again, was at 2.0%, which is basically right in the center of what we would historically expect the GDP figure to be released at. During very, very bad times, we saw GDP decline to levels of negative 6.4% in April 2009. The previous low before that was 1991 at negative 3.5%. And a negative 1.3% in April of 2001. Now, usually economists will classify an economy in a recession when you have two consecutive quarters of negative real GDP. So for the GDP to go negative for 2 quarters, that's something that we would call a recession. So although the economic conditions are certainly not good these days, it's not considered a recession. During the really good days, we had GDP that was at 5.6% January 2010. Before that, 5.4% April 2006. And it's the change that we're looking at. We know that the economy was not in great shape in 2010. But the recovery off of the lows of 2008 makes this GDP expansion look and made it feel so good at the time. Again, it's not that because the economy was so good in 2010. It was because in 2010 it was so much better than it was in 2008. Now, the correlation from GDP to the dollar in the old days used to be very easy to talk about. When GDP rose, we would say, well, the U.S. economy was expanding, and therefore we would expect the Federal Reserve would be more likely to raise interest rates. The expectation of higher interest rates would lead traders to buy the dollar and sell other currencies. So when GDP would go up, the dollar would go up. When GDP would go down, the dollar would go down. What we're looking at now over the past couple of years, and it's exaggerated now more than ever, is a divergence between the two. Regardless of what GDP does, the dollar continues to enjoy a general trend to the downside. Today's number, the expectation is 2.8%. Last month, 2.0%. There's a number of different ways that we could try to understand, we could describe why this divergence is taking place. Initially, years ago, I would say, well, this occurred as a result in part of the U.S. going from budget surplus to a budget deficit. Not that the overall national debt was paid off, but in the 90s we were running at a surplus for a short amount of time. And as a result, we had that positive correlation. When GDP expanded, the dollar tended to go up, and both would tend to go down as well. But as we moved in the late 90s from a budget surplus to a budget deficit, the U.S. economy overall had to succumb to borrowing money. Borrowing money by operation through the bond markets, borrowing money through quantitative easing that we talk about these days, borrowing money from China and from other borrowers, borrowing money from our own U.S. consumers as well. And as you put into simple terms, as we're running our own budget for our own households, and we make a certain amount of money every month, and a piece of that money goes to pay rent or mortgage and pays for the car and the food and all that other stuff. As long as we continue to make enough to pay our bills, and hopefully a little bit more than that, we should generally see a positive correlation between our salary and the amount of progress that we make as far as a household income is concerned. But if all of a sudden we start to spend more than we make and we borrow the excess, the extra money that we need, when we borrow that money, it does not, and if we were to chart our own household wealth, which I guess is what I'm trying to say, the line would look the same way. Meaning that, okay, let's say we need $2,000 a month to pay for the mortgage and the lights and the electricity and all that stuff. If we have to borrow $500 extra on top of that $2,000 every single month just to pay the bills, or if we make $1,500 we have to borrow the other $500, what happens is our household wealth does not go up. In fact, the household wealth goes down. Because all the money that's borrowed in order to pay the bills, well, there's interest attached to those loans. If we borrow money from a credit card, or the Federal Reserve borrows money from, printing new money in the form of quantitative easing, whatever it may be, there's interest or some sort of penalty attached to that borrowed money. As a result, we have to pay the interest plus our bills, so our actual net worth actually begins to decline. Same kind of thing that happens on a countrywide basis as well. In terms of quantitative easing, we're not necessarily borrowing money from another country, but we're diluting our own currency in order to fund the purchase of long-term treasuries and mortgage-backed securities and all the other good stuff that the Federal Reserve does with this money. But think of it a different way. If we're printing new money to buy long-term bonds and to buy mortgage-backed securities in the form of quantitative easing and Operation Twist, each one of our dollars, and we talk about this all the time, each one of our dollars is diluted, it has a little less buying power because there's simply more dollars out there in circulation that our dollars have to compete with. As a result, commodity prices rise, more dollars are competing for the same barrel of oil, the same bushel of grain and ounce of gold, and etc. So we lose buying power. Think of it almost as a tax where it's a necessary evil. We have to spend more on gasoline, but hopefully the Federal Reserve is hoping that the additional rounds of quantitative easing and Operation Twist will boost the economy enough or we'll turn around. So what does this all mean in terms of our trades? GDP is expected at 2.8%. Previous numbers 2.0. Let's say the GDP comes in much, much better than expectation, 4%. It's not going to be there, but let's just take an extreme. Let's say it comes in much, much better expected. What can we expect from the dollar? Well, if GDP comes in much better than expected, it means that whatever the Federal Reserve is doing seems to be working. That the current round of Operation Twist, QE3, anything else that they're doing at the moment, that's working. That means the Federal Reserve is probably a little less likely to extend Operation Twist any further than they already have. They're less likely to enact another round of quantitative easing. Whoops. Testing the audio. Please let me know. Please let me know if you cannot hear me. If you can't hear me, I assume that you can. If you can't, then that's why I typed it in. Okay. Okay, so if the number comes in much better than expected, clearly beating the expectations, then the Federal Reserve is less likely to initiate another round of quantitative easing, more likely eventually to go down that path that, okay, we might see higher interest rates sometime in the future. It's not going to happen tomorrow, 2014. The earliest, most economists agree, is probably late 2014. But late 2014 is a lot better than keeping interest rates at zero until 2015 or 2016. Well, as a result, we would logically think, well, the dollar should go up because it's less likely that we'll see more Fed action to dilute the dollar, and we're moving a little bit closer to raising interest rates. But that, I think, would only occur if the GDP number clearly was improving. If the GDP number was a clear disappointment, 1.5%, that means that Operation Twist, that's on the table. It's on the table right now, And the Federal Reserve has already pledged to keep it on the table, meaning to continue to buy long-term Treasury bonds and sell an equal amount of short-term maturity Treasury bonds. They've already pledged to sustain that until employment and GDP numbers come significantly better. By the way, instead of us guessing what would be a good number, we actually know what a good number, what the Federal Reserve considers to be a good number. Go to the website, the Federal Reserve website. The Federal Reserve creates projections. The projection right now, and we're looking at the upper end and lower end of the central tendency. For 2012, the Federal Reserve has projected that U.S. GDP should fall between 1.7 to 2.0%. The range for the entire year, as far as their projections are concerned, this is the link, 1.6 to 2.0%. So if we clearly beat expectations of 2.8%, if we come in much better than expectations, 3.5%, it will clearly exceed the projections that the Federal Reserve has deemed necessary to have interest rates in its current level of monetary policy. So this gives us a very clear framework as far as where the number comes in and what we can expect for the Federal Reserve to do. Now, there's a lot of other factors within the equation. In the U.S., we have the fiscal cliff, which are these tax cuts which are set to expire January 1st, 2013, December 31st of this year. And right now, Congress, I'm sure you've noticed, is in session, and they've been meeting and debating and coming to very, very little conclusions about what should be done. And that if no real solution is met or is found, these tax cuts will expire, taxes will go up on many, many people, and it's perceived, at least from Wall Street's perspective, not to be good. I think everybody would agree would not be good. So what can we expect from GDP, even if it comes in good today, if a solution is not found by the end of the year in terms of the fiscal cliff? That could be very detrimental. And although the GDP number is usually very important, by the way, we only have 3 minutes, 2.5 minutes to go until the GDP is released. Even if the number comes in very, very good today, the big issue, I read once in the book that the market only has 5 or 6 different issues that it tends to focus in on, and it'll just go back and forth and focus on from one issue to another from time to time. Sometimes the stock market or the forex market's concerned about geopolitical tensions and wartime, peacetime. Sometimes it's worried about the pure economics, GDP, whether we're in a recession or not a recession. And sometimes we look at the more geopolitical environment and that impact to the market. At the moment, the fiscal cliff, I would say, is number one. And it's kind of tricky because normally we have the economic numbers released 8:30 a.m. Eastern, and then the market develops a trend, and it usually quiets down during lunchtime. However, I would encourage everyone to be very, very careful about having trades open in the middle of the day, because although GDP is important now at 8:30, this afternoon we may have some Speaker of the House or a congressman or senator come out, walk in front of a TV camera and say, you know what, we just had a meeting, we can't agree on anything, we don't think anything's going to happen, so on and so forth, and as a result, we expect the fiscal cliff will come to this head. And that could severely move the market. We've seen that happen already a few times this week alone. By the way, in the Dow Jones News tape, Fisher, which is a Fed official, is speaking, says the most important global issue is resolving the fiscal cliff. So he agrees with us. Odds are long of a quick solution on the fiscal cliff, meaning they're not good odds that we're going to find some kind of solution. And Fed's Fisher says the Federal Reserve needs to define soon how far it's willing to go. I agree. I don't think that'll be the case. By the way, if you see the GDP numbers before me, please chat them in. Less than 60 seconds now. The Federal Reserve has been saying this for a while. Fed officials have been saying this for a while. And I kind of like to equate it to the boy who cried wolf, meaning that they've been threatening, the Federal Reserve has been threatening for a long time. We're going to tell the world how much quantitative easing is enough, and then we're not going to have any more. 2.7%. Wow, got the numbers fast. Like all good journalists, we have to confirm this with two sources. So I'm going to look to the FX Street calendar. Not that I don't believe you, I do. Oh, we have two sources in FX Street. 393,000 jobless claims. By the way, here's the FX Street economic calendar as well. I don't know where you're getting your news, but it's faster than me. So, and it's interesting because Bloomberg actually put together a poll. I saw it just a few minutes ago, as far as the market's expectation of whether we'll come to a good resolution or not, or a long-term or short-term fix. And I think the consensus is at least a short-term fix will be met, and they'll probably, as these economists say, kick the can down the road, which means do just enough in order to postpone the inevitable. How will the market react as a result? It's anybody's guess. 2.7% GDP. Initial jobless claims down 23,000 to 393. I guess that's good news. Third quarter preliminary GDP 2.77%, which is what we know, versus the advanced figure last month's report 2.0. The consensus was 2.8%. Now I'm watching two things right now. I'm watching the U.S. dollar against the Swissy, and I'm watching the Dow Jones Industrial Average futures. And we'll put this on the chart side by side. Let's do it like this. Here's a dollar Swissy. On the top, 5-minute chart, Dow Jones Industrial Average. We'll try to figure out why both moving as they are. The initial reaction, which I always find very interesting, is for the dollar to go up and for the Dow Jones Industrial Average to go down, which actually kind of makes some sense. Because, okay, so we missed the estimates of 2.8%, and there's a lot of components actually going to the GDP. But overall, the U.S. GDP is expanding. 2.7 is a lot better than 2.0. This means Federal Reserve a little bit less likely to continue Operation Twist perpetually. Now, what we were just talking about, right before the GDP number was released, Fed's Fisher said the Fed needs to define soon how far it's willing to go. And then I said, well, this is kind of like the boy crying wolf. At the Federal Reserve for a very long time has been saying, you know what, we really need to define how much monetary policy is enough. We lowered interest rates down to zero. We kept interest rates down to zero for 5 years now. We pledged to keep interest rates down to zero, keep rates to zero at least through the end of 2014. We created quantitative easing 1, quantitative easing 2, quantitative easing 3, Operation Twist, cash for clunkers, first-time home buyer tax credit for new home buyers, and a dozen other programs. But we, meaning the Federal Reserve, we need to define how much is enough. But they haven't done that so far. Operation Twist, which is kind of like quantitative easing, except that they're not printing new money because that's too detrimental to commodity prices. That Operation Twist, where they buy long-term Treasury bonds, they sell short-term Treasury bonds. I happen to think it's not such a wise program to allow to persist perpetually, because it really hurts bank profit margins when you compress the yield curve on the bonds, which is exactly what they're doing. But there's no end date as far as Operation Twist. It was supposed to end in June, last June, this past June. They extended it in June to the end of the year. But now it's perceived by many that Operation Twist will continue well into 2013. The stock market will become, and I think already has become, very dependent on quantitative easing. And we can look at this the same way on this chart. The violet line is U.S. GDP. In the old days, and the blue line is the Dow Jones Industrial Average. In the old days, when GDP would rise, the Dow Jones Industrial Average would go up. When GDP would fall, the Dow would go down as well. What's happened now is the Dow Jones Industrial Average, are we really at a point at the economy that it's so good that we're looking at levels we've not seen since 2007? Well, GDP does not tell us that, not at all. The Dow Jones Industrial Average does. If we were to judge the strength of the economy based solely on the price of stocks, we would think that the economy was in very, very good shape right now. GDP is not where it was in 2007, 3.2%. And prior to that, 5.4%. In fact, take a look at the violet line. If we were to draw a trend line connecting the highs, we would see some kind of down-sloping GDP number since the peak, which was reached again in 2007, when the U.S. economy went from a budget surplus to a budget deficit. Since the moment in time that we start to have to borrow money to pay our own bills as an economy, the GDP has failed to establish higher highs, and in fact has established lower highs and lower lows. After all, the GDP in 2009 was in a lot worse shape than it was in 2001, and even a lot worse shape than it was in 1991. So that's where we stand. The common GOP should carry all the blame for the America's woes. I would say, in terms of the economic numbers, GOP, I thought you said GDP. There's so much more that goes into the picture in terms of what makes an economy function and what makes an economy competitive. You have monetary policy, which is basically a race to zero, where all central banks have reduced interest rates to zero as fast as possible, have kept interest rates down near zero as long as possible, and have created as much quantitative easing as possible. But that's monetary policy. On the other side, we have fiscal policy. We have taxes and regulation. We can say, well, a company has to pay a certain amount of taxes in one country, and other taxes in another country, faces regulations in a certain country and more or less regulations in another country. And we live in a ever more global economy these days. And that how can a company expect to be competitive in the U.S. when the U.S. has the highest corporate taxes in the world? And how can a company expect to be competitive when we have pretty much the highest amount of regulation in the world as well, versus other countries with lower taxes and less regulation? So I think all that goes together to create the economy that we see in front of us today. But from a trading perspective, what I think is really important to try to take away is to anticipate how this fits into the big picture. GDP is at 2.7%, clearly an improvement over the previous month's estimate. Not 2.8%, but those estimates are computed by analysts and economists. The physical improvement, I think, is more important to know. But does this really mean a lot? Not as much as the fiscal cliff issue. I think that definitely carries precedence, at least between now and the end of the year. Also, we want to see a broad-based improvement, not only an improvement in the GDP, but in the other economic barometers, such as the unemployment level. First Friday of the month. Take a look at this chart. This shows us U.S. GDP, which is the red line, U.S. unemployment level, which is the blue line, and the violet line, which are interest rates. Now, first compare the red line to the violet line. That's GDP to the Federal Reserve historical interest rates. GDP goes up, interest rates go up. GDP goes down, interest rates go down. Interest rates bottomed out here, starting in 2008, 2009, and have stayed this low despite the recovery in interest rates. The unemployment level tends to have an inverse or opposite correlation to interest rates. The blue line is unemployment. Unemployment goes down, interest rates go up. When unemployment goes up, interest rates go down. Well, unemployment hit historic highs, but has since then come down quite a bit. Interest rates hit an historic low, but have not gone up. How do we explain this divergence? How do we explain the divergence between the unemployment level, which has clearly improved since the worst levels of 2010, 2009, and GDP, which has clearly improved since the lows of 2008 and 2009? How come interest rates are still at zero? Shouldn't monetary policy reflect the improvement in the economy that we've seen so far? Well, one way you could look at this is say, well, since 2008, 2009, taxes have gone up, regulation has gone up, and this is all aside from the economic factors. You know, when we talk about GDP, GDP is just a net result of new home sales, pending home sales, retail sales, all the other goods and services that are produced in the country over a certain period of time. That's GDP. The unemployment level just reflects how many people are working to produce those goods and services that are reflected in the GDP, and of course CPI reflects the prices that we pay and we charge for these goods and services. Now, the reason why we have this correlation between interest rates is that as GDP rises, it's perceived that the economy is improving. But is the economy really improving since the lows? Well, the unemployment rate, I would argue no. In fact, I recently read a statistic, yesterday, that said if they counted the unemployment rate the same way they counted it in the 1930s, if they calculated it the same way, the unemployment rate this year would actually be worse than any single year during the Great Depression. That the real unemployment rate in the U.S. would be around 23%. See, right now, you're only counted as being unemployed if you're actively searching for a job, if you haven't given up on a search, if you're not working part-time, or you haven't, been in the workforce for quite a while. That right now, that if you drop out of the job hunt, if you say, okay, I give up, I can't find any work, or if I'm partially employed, that's not counted as far as being unemployed. The only people that are truly unemployed are those that are actively looking for work, that are not working part-time, that are what they consider underemployed. They're not making enough, but they're making some. So the economic numbers, you have to take them with a little grain of salt. Also in terms of GDP, is Apple Computer really selling as many iPhones as the GDP number would reflect, 2.7%? Did our economy really expand 2.7%? Or did quantitative easing lead to inflationary pressures which caused the prices of goods and services to go up despite the economy not recovering? I mean, after all, quantitative easing, QE3, Operation Twist, it's injecting new money into, not Operation Twist, but quantitative easing, it's injecting new money into the economy. So every consumer, I know we don't feel it, but there actually is a little bit more money out there in circulation. Now let me correct that. It's not that we as consumers have more money, it's the fact that there is more money in the economy. There's new consumers in the economy. Who are these new consumers? It's the Federal Reserve buying long-term treasury bonds with the money that he printed from quantitative easing. So I normally would buy, let's say, one treasury bond every year, and you may buy one treasury bond every year, and all of us put together, we buy X amount of treasury bonds. But now that the Federal Reserve, through quantitative easing, is buying long-term bonds, there's other new treasury bond consumers out there. There's no new consumers buying mortgage-backed securities. You buy the bonds, the bond price goes up, the yield goes down. The yield and the bonds go down because there's more buyers and sellers. Stocks become more attractive. I can say, well, I used to get 3% on a 30-year bond, and now I'm only getting 2.5%. I'm not getting as good of a yield. Let me consider buying some stocks instead. They look a little bit more attractive now that I know that I can't get any yield at all in the bond market. That's why I think GDP is at 2.7%, not 2.0. Not necessarily the economy is getting better, but there's more bond owners out there. And when you have more people buying bonds, stocks look more attractive. And also, quantitative easing de-incentivizes us to keep money in our bank account. I used to get 1% in the savings account, now I get half of nothing. So why would I want to keep money in the savings account? Why would I want to buy a bond and get into zero interest rates or a CD? Let me put my money into stocks. Let me buy a new car. Let me buy a home with 30-year mortgage rates at historic lows. Let me put that money back into the economy. That's what the Federal Reserve is hoping. That GDP will improve as a result of new consumers. We're going to create new consumers. We're going to put those new consumers into the market. They're going to compete with us as if we didn't have enough problems, right? Now we have to compete with additional consumers. And the net effect is that the economy will improve. which I think is one of the reasons why GDP rose today. Not to take all the credit away. I mean, maybe business is improving. I know some sectors in the economy, like housing, has improved recently, except for yesterday's number, of course. But I think that we have to look at these numbers with a little bit of a grain of salt, because I don't want to use the word manipulated, but it's an economy that it's not improving completely under its own volition. It's improving as a result of quantitative easing. And that also creates a little bit of a glass ceiling for the economy. And this is really the point I was trying to get to before, that let's say the numbers get much, much better. 2.7%, 3%, 4%. What happens if GDP really continues to go up? Eventually the Federal Reserve is going to say, okay, you know what? No more quantitative easing. No more Operation Twist. Before we even get to a point where we see higher interest rates, what we're going to see is the end of Operation Twist. And that will naturally start to depress the economy. Because the economy right now, 2.7% GDP, that's not 2.7% of the U.S. economy. I'll make up numbers. I'll say it's 2.3% U.S. economy, 0.4% monetary policy. Which means if you were to take Operation Twist and quantitative easing away, GDP would not be 2.7%. It'll be lower. So what happens when the economy actually does get better? We're going to get less quantitative easing, less monetary policy, and then we'll start to naturally see things start to slow down. Same thing with the unemployment rates. We came down from highs of 10.1%, where it's, 7.8% now, I believe. What happens when the unemployment rate drops to 6.5%? We're not going to need so much Operation Twist or quantitative easing. More people will be back into the workforce, but then without that Operation Twist, maybe businesses are not going to be able to hire as much. And of course, all this goes around the fiscal cliff that's slated for the end of the year. Now, politically, you could blame one side or the other. I can't imagine, under any circumstances, how raising taxes or allowing taxes to go up even on one single individual could be good for anybody. But that's a debate that we're under right now, and to be very aware of the implications that if a deal is not reached, what will that implication be to the U.S. economy? More importantly, what will the credit rating agencies like S&P, Standard & Poor's, which downgraded, remember they downgraded the U.S. credit rating August of last year because of the very same event. Fiscal cliff, we couldn't meet a resolution, and we said, okay, we're going to just postpone the entire discussion. Standard & Poor's didn't like that. They downgraded the U.S. credit rating once because of that. Maybe Moody's will do that again. So please be aware of that. With that said, I'm out of time. If you have any questions, you can contact me directly, www.forex.lounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have a lot more ahead of us. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Street.